Hey everybody, Preston Bryn here with our Trader User Group. This is for the trading week ending October 4th, 2019. Thanks for tuning in. This past week's theme, I call it In Search of the Golden Goose. Now, we saw this past trading week, which kind of kicked off the first week of October. The Dow, S&P, and the Russell were all down. NASDAQ just finished about 54 basis points in the green. That's almost a little bit more than 0.5%. We had a pretty big wide price reversal coming out on Thursday and Friday. I'll talk about that in 1 second. Volatility really didn't come in too much. It closed the prior week at 17.22, and then it closed this past Friday at 17.04. So it fell just a little bit, but just barely. It shows that vol is still active in these markets, even with this wide price reversal that we had Thursday and Friday. Also, looking at the world markets, folks, the FTSE was down over 3.5% for the week. The CAC 40 down over 2.7%. The DAX was down almost 3%. The Nikkei was down over 2%. China was down about 1%. And the Hang Seng for Hong Kong, it was down about 50 basis points. Of course, it's down over 25% for the year because of all the turmoil going on over there. And then here in the U.S., the best performing sector was technology, while materials brought up the rear at 2.54%. And then the other thing I'm looking at is the trailing 12-month PE ratio was 22.6. And then going forward, we saw the forward PE is at 17.6. So that represents a drop of about 22% on earnings estimates PE ratio from prior 12 to the forward 12-month guidance. The other thing that is note here is the S&P annual dividend yield is about 1.93%, and the 10-year interest rate is sitting at 1.51. So you can get more than 40 basis points of yield by going into equities, and it tends to push money into the equity market. So that's one of the things that is at least positive for equities, along with all the corporate buybacks. So this kickoff to October, it did start on a sour note, and it tends to fit the pattern that October is one of the more volatile months of the year. We're seeing heightened impeachment fears that's kind of surfaced up over the past week or so. More tariffs against Europe, with the U.S. winning in the World Trade Organization against Airbus. We're seeing the protests in Hong Kong escalate more. Wednesday of this week, we saw data come in weak on the ISM data. And then at the tail end of the week, we had kind of a semi-decent, I would call it a Goldilocks jobs report that tended to move the market some higher. And I think on the back of that also was the idea that the Feds, this economic data is going to push the Feds more to raise the rates. The ISM data came in at 47.8. That's below 50, so it shows contraction. And even though manufacturing is about 10% of the U.S. GDP, and the big mover is consumer spending, it's enough to affect the markets because it can affect consumer sentiment. But that's the lowest reading we've had in the ISM data, manufacturing data, since 2009. And then again on Friday, which really moved the markets higher, we had jobs data. They revised up in previous months job data, and then Friday it came in at 136, about 136,000 jobs added. And to me, the line in the sand was anything less than 100,000, we would have seen the markets continue to sell off, but it didn't. It finished at 136, and then we got an unbelievably spectacularly low unemployment rate of 3.5%. I think that's the lowest since 1969, so almost a half a century mark going back in time. Really amazing. So net the picture out here, we're seeing slowing economic data, but the U.S. is still growing. All right, so just kind of keep that in mind. And last year and the year before, the Feds were in the process of a 3 or 4 year Fed rate hike, and it's only last year that they stopped it. Okay. The end of last year in Q4, that was their last rate hike in December, when Jerome Power Ranger Boom Boom Powell made the mistake of hiking the rates and creating a really huge, almost bear market condition in Q4 of last year. He did that for the Russell. But he reversed his stance. But it takes about a year or so for interest rate hikes or cuts to work their way through the economy. So we're getting some of that now. And all of this data has kind of washed up on the Fed's windscreen. And what we're seeing, what I'm seeing is the markets are pricing in just about an 80% chance of a rate cut the end of October. Remember, the Feds meet in about 3 weeks, the end of this month. They do not meet in November, and then they meet again in December. So the markets are pricing in about an 80% shot of one rate cut, and just slightly less than a 50-50 shot of two rate cuts. So I think they're going to get that one rate cut the end of this month. Okay, we're also seeing a little bit of a balance sheet. I think the Feds are going to put some money in the balance sheet, that kind of thing. So to help with some of these overnight loans, these repo actions, so that'll help a little bit. And the New York, I also saw in Barron's the New York Fed model is putting in the odds of a recession at 38%. I think that's a bit high. Of course, that means there's a 62% chance there won't be a recession in the next 12 months. But I currently in the camp that I don't see a recession hitting the U.S. markets in 2020. I don't see that just at this time. I mean, things could change. I mean, we could continue to drag on this trade war issue with China. We can continue to see other things happen, and then we're going to have the elections next year, and that's going to kind of take the circus and focus the spotlight on the presidential circus, which I'm sure it will be. I'm sure it's going to be one of those things. So keep in mind also last year, around September of this time last year, the U.S. 10-year stood at a little over 3% interest rate. Now it's down to 1.51%. So that's that's 150 basis points, guys, drop in the 10 years. So there is ample push in this search for yield, this quest for yield to drive money into the U.S. equity market. All right, and we're still getting a lot of that also in the um, European markets as well. So that's kind of what we got going on right now. What I've got on the screen is the daily chart using Ichimoku. And you can see where, and I'm not going to get into the details of how to read an Ichimoku chart. We've got a great session in our Option Masters on it. If you're not in our Option Masters or in our group, you ought to come on in. We're having a good year. Last year was good. I think this year will be better, even better. And then next year is going to be, I think we're going to have some huge opportunities in 2020. But if you look at the Ichimoku, you can see here where this red cloud here kind of performs support for us. And then we've moved up. We're still in a sell. It's a kind of a mixed bag right here. And looking at the Ichimoku, so you can see the red line below the blue line, but we're above the red cloud here. But looking forward in time, you can see a green cloud. So there's a little bit of a projection out here that would suggest there's still a lot of headwinds in the way, and we need to clear this 2960 area. And what I would say in other charts, really the 2940, and we're starting to clear that now. I mean, we closed at 2950. If the 2940 can hold, I'll be a happy camper if we can see that hold through the next week, okay? Let me just shift the screen here, and I'm going to take you to another view of this. And I'm going to go to a Bollinger Band view of the chart. And what this Bollinger Band view, same chart, E-mini futures, you can see here on the Bollinger Band, and I've got three bands on here. So the red band is the 3 standard D, purple is 2, which is the traditional Bollinger Band, and then blue is 1, and then yellow is the center line. You can see generally when we come down and hit 3 standard deep, we have that bounce back move. All right, it's almost like a tremendous oversold condition, right? When we get we hit the red, then we kind of bounce back up. In this case, we bounce back up and just kind of found support around trailing the blue line, right? We came down here and we hit the red, and then we bounced back up and we just kind of moved just slightly above the blue, but really couldn't get above the yellow when we came back down again. So here again, we hit the red, now we're backing back up, and like most of these others, we're sitting between the blue and the yellow on the standard dev of this Bollinger Band. So like I said, I want to see us get some elevation, and I want to see it hold for me to really count this. You can see an Elliott wave count on my screen that would indicate this is a 3-leg, which would suggest we can bounce back up here and then have a lower 5-leg down here before this is all said and done. Okay, and that means it could take us back down into this 2800 area, lower 2800, probably even in the 2700. So I am still not ready to say let's go all in with the bulls, even though we had a strong finish last week. Okay, and then I'm going to show you one other chart, which is just a simple bar chart of the exact same graph. Let me just find the screen. I got so many monitors on my computer here. So if we look at this, you can see here on this weekly chart, look at the candle. That is a huge bullish candle. It's almost like a hammer, which would suggest we can go back up. And depending on where earnings are, there's really three key factors in my mind right now on whether we take out these all-time highs of 329.50 or not. Okay, one of them obviously is the China trade tariff issue. There's tariffs that are supposed to hit on October 15th or 16th, but I think what Trump has set himself up for is one of these kind of tweets that said we're making progress next week. So in the progress, in a sign of good faith, blah blah blah. I'm gonna push the tariffs out to next year to see if we can make more progress. Blah blah blah, that kind of thing. That'll be good for 20 to 40 points in the E-minis, 300 points in the Dow. I would expect something like that towards the end of next week or even in the weekend, because they're going to start meeting. They're bringing their head negotiator over. So I would expect some news like that. The flip side of the coin is if we don't get anything and it doesn't come out very good, then we could come right back down here again. Looking at these charts, now if I put it back on a daily chart, and this is why this shaded zone here is so important. If we look at this shaded zone right here, you can see here, this was the breakout point before, all right? And we spent a lot of time here. In fact, let me just take that off the screen and let me redo it again here so it makes sense to you guys. Let me just show you. We spent over a month in this area trying to break out right here in this zone, over a month. And then finally, and we've had a number of runs at it, right? We had one run there, another run there, a run there, and then a run here. And then finally on the fifth try, we finally were able to break up, but we could not make new all-time highs. There was just not enough data and gravity and momentum to get us up above and make new all-time highs. And then we came back down, but notice we tested the 200 EMA. It held nicely. Intraday, we closed below. We had some wide swings, but we closed above the 200 EMA. And now we're sitting right on the 50 EMA. But here is this zone again, right? So what was resistance is now support, and what's now support is now resistance. So you can see, I want to see us get north of this level, come back, possibly test it and move higher. If we don't do that, then, and we break this area right here, that would be signs that we're going to come back down and test the 200 again. And I would encourage our members, and for those of you that, come on board with us, I would encourage you to look at some of the things that we would do to play this to the downside. Okay, we have a couple of trades that really play nicely in a rising volatility market. So that's something that I'm going to watch very closely here with these charts. Okay, if we look at and notice we're sitting on the 50, we're above the 200. If we look at NASDAQ, which was the only market to finish just slightly in the green for the week, again on the daily chart, we closed above the 50, above the 200, and notice the 200. Every time we've gone below, we've moved up above it very quickly. We only closed below it one day. Below the 200, that was back in early August, right? And then the last time we closed below it significantly, and that was just only 2 days, was back in May. So this 200 EMA has been a very solid support for technology, okay? And I would expect this to hold up again. If it breaks, much like it did in May, it could get ugly if we see other things drag down. But now let's turn our attention to the Russell here for a minute. All the other charts are more bullish in nature. The technicals are more bullish in nature. The Russell is not. We see the 50 below the 200 and price action below the 50. We've got a solid support area down around the 1450 area, right? You can see down here where we come down and it overshoots a little bit, but I'm not a big sticker on hitting it to a penny because that's just more human condition of loving precision, but that's not the way the markets work, as you always know. I am always fond of saying, guess which way the drunk is going to step in his next step on a sobriety test on the yellow line. Is he going to step to the right or to the left? You don't know. Once he gets momentum going, as a drunk knows that, well, doesn't know, but as a drunk starts to go one way, his whole body cants that way. Well, here's the markets here. So we'll tend to overshoot both up and down. If we overshoot, but we continue running, that's going to be very bad for the bears, and other markets as well. So I want to see this. And the market never really did recover. We crossed back here in May, and you can see we almost got up above here, I think maybe for a day or two, and it went back below again. And then we got back up here again. And this is a huge level for the Russell, very big, around the 1490 area, 1590, sorry. Very hard for the Russell. So until I can see some breath in this one as well, then we need to be very careful. And the odds favor the risk of the bigger move right now is to the downside. It's not to the upside. Okay. And that's just the way the markets are playing themselves out. And if we look at volatility here, you can see on this daily chart, vol came in a little bit, but not much for the week. I mean, we were up mostly all week, right? And then boom, we just kind of came back down the last couple of days. So Monday, Tuesday, Wednesday, we came up. We peaked in the week around 2150. We could not get up into this slightly rose-colored red zone in VIX, but we're back down here again. And if I look at the front month and back month skews, let's just look at the front month skew first. We're back in a normal contango environment, but just barely. All right, we're barely in this contango environment. Red would be a backwardation, which means the VIX, the spot VIX, is higher than the front month vol futures. So this is kind of where we're sitting, right on the fence there. And then, of course, if we look at the back month, you can see even in the back month, we had this huge move up on Tuesday and Wednesday, and then this huge move back down. So we're right back almost where we started with back month. That would be October, November timeframe. So vol up front, there's a little bit of fear. As I said, the VIX is still sitting, or the VIX closed the week, still elevated right around 1704. But I want to see the VIX come back below 15 again. If we're staying elevated, there's still fear and panic. Not panic, but fear. Panic is when we move into a backwardation in these skews, and we don't have them yet. But look at the bond market. I mean, the bond market still finished up. It's just small little drip, drip, drip to the upside. It's grinding higher. And a lot of analysts, and I've read them, some of the reports, all of them are expecting interest rates to come down to 1%. I mean, we've got the ECB on record is putting more stimulus out in Europe. I mentioned earlier there's like 33 banks around the globe that have cut rates over the past year. And here in the U.S., there's talk now of about an 80% chance of a rate cut the end of this month. So all these rate cuts just continue to drive the bond market higher and interest rates lower. I mean, if we look at the 10-year right now, you can see right here, we're not down at the 2019 lows yet. The 2019 low, let me just put it on here. The 2019 low is at 1.401, which is almost a decade low. But you can see we're still low nonetheless. My system has calculated also, the analysts have said 1.0. My system, just looking at Elliott waves, it's projecting an Elliott wave 5 count around the 1.15 area. So if that happens, the dollar is going to get stronger, guys. And speaking of the dollar, even though it was down a little bit on Friday, look at the regression line right here. And here we go. Every time we get up north of the blue line, I'm having our members go long the euro dollar or short the dollar or buy puts in UUP because it just gets very stretched every single time. Same thing up here. We almost made new 2019 highs. That would have been a good time to just pick up some puts in UUP if you want to trade the ETF that tracks the US dollar index, or just go long the euro dollar because the euro is about 58% of the dollar index. So wherever the dollar goes, the euro goes in the opposite direction. But now that we're inside the regression channel again, it may soften just a little bit, just because it's a little bit overbought, I believe, because everybody's cutting rates. And if we cut rates and the odds favor that, that's going to put some more downward pressure on the dollar relative to other currencies. And then, of course, if we look at the euro, The euro, let me find it on here we go. The euro is just the opposite. You can see here on this regression channel here, we came down and we came very close. Let me just blow it up just a little bit here. We came very close to matching the lows. Where was the low on that day there? 1092, yeah, so just a little bit lower right there, 1092. So we came very close. We've tested it a couple of times, but we got some divergences in here, positive divergence that would suggest the euro is going to move back inside the regression channel, which is what I was expecting and forecasting and suggesting that you can play it by going long the euro or shorting the dollar for a short term. It's just a swing trade. Longer term, I think the euro is going to go even lower. I've never been a big believer in the euro. It's just, I don't know how you're going to round up 19 countries and create some kind of monetary policy across 19 countries. It's going to create division and rancor, which is what it's doing. And that's what's kind of driven that whole European game right now in terms of populism. So that's what's going on over in the currency market. If we look at Japan, the yen, it tends to follow the US bonds. Okay. It's a global safety trade. And if the yen rolls over, we're going to see the dollar roll. I mean, we're going to see the bonds roll back over and interest rates come up a little bit. But this is the yen right now, okay? So it's kind of following the bond market. And then, of course, if we come down here and look at gold, gold is still maintaining the 1510 level. It's doing a series of lower highs and lower lows, okay? I think gold long term is a buyer. It's a winner. But short term, if you guys remember last week and before, I said I could see it coming down to 1425. Okay, it regained the 50 EMA. Gold trades technicals very well. So if it breaks, to me, shorting gold would be a good short-term swing trade, even though long-term I'm bullish. If gold falls below 1465, 1462, 1460 area, that would be taking out that low. It's going to come down to this value area right here about 1421. Okay, so that would be a play that to me would have a better risk reward to the downside than to the upside, right? And if we look at silver, it's the same thing. With silver, you can see this bounce higher. Near term, we're over the 50. Now, I was getting our members in silver way back over here. Okay, we were getting entry prices below 14 and a half, 14 in silver. And that was just turned out to be a great trade. When it got up in this area here, then it was time to pick up some puts. I didn't sell silver. I just picked up some in the money puts. And the only cost basis was the cost of the puts. So I just reduced my profits by the cost of the puts, but it allows me to stay in the trade and see if we get a really wild ass swing. If we don't, then, que sera, sera, and then I'll just come out and we've got great profits in the trade right now. The other one that I'm watching, we made a killing on about 6 months ago, is palladium. As you can see right here, palladium continues to make new highs and just really up in this area here like this. I think the risk is starting to get more to the downside than the upside in palladium. You can see this upsloping channel here. Palladium really kicked it off in summer of 2018, and it's just been moving higher ever since. Okay, we did take this trade here. It was a text box setup trade. We took it and shorted it, and I know some of our members made over 20, 23, and $30,000 per contract in this trade. In about a 3 or 4 day period. Really great trade. I'm looking for a similar kind of thing. You could see how far away from the base trend line it got. So that was a good one. We're closer to the base trend line here. But I think, again, the risk is more to the downside than the upside. Because palladium does not have calls or puts, it's harder to hedge a long only futures trade or a short only futures trade, which is why they tend to run really fast. Okay, but it's a good day trading vehicle for those of you that like to day trade. For us in our group, we traded it more on the day time frame, and we made a killing back over here. So I'm waiting for a better setup. If I get it, then our members will certainly be able to participate in it if they want to follow me in the trade. Looking at oil, you can see here oil finished the week at 53.01. We're at a key support area. You guys know if you've been following me for a while. Oil in the mid 50s, 55 is kind of where I've been settled on oil. And then we just regravitate $5, $6 a barrel above and below the 55 level, but call it the mid 50s. Okay. But recently I changed it just a little bit, and said I'm neutral to slightly bearish, but I do believe oil right now is a victim of where we go with the China trade deal and global growth. And global growth is a factor of the trade tariffs or lack thereof. If that gets solved pretty quickly, we'll see oil move back over 55 a barrel pretty quickly. Okay. So that's a little bit about what I'm seeing in the oil market. And when oil had that big gap up, right, when the cruise missiles hit one of the largest refineries in Saudi Arabia, I was telling our members this was a perfect time to fade that gap. I mean, it went from here all the way up to here, and it even closed on that day, so it gave you a chance to even chew on it and think about it. And it on the point where it closed, it went from 61.87 up to 62.52. So, about 80 cents up, $800 per contract up. But if you were willing to withstand some of the pain and put a sell stop above the 63.34 area, which was the first gap, then you would have made a lot of money. Day trading it or just picking up some puts in the option market in oil futures would have been a great trade because it clearly closed the gap and then it came all the way back down here. So it's from a distance standpoint, it's moved over almost $10 a barrel from the gap high down here, maybe even more than that. $12 a barrel from the gap high to gap low. So these are some really good trades. Anytime we get this displacement in the commodity market, I really love it because it really makes it a little bit more fun. There's things going on in the ag market now with China buying tons of soybeans. That's going to affect beans and wheat. For our members, I've already put in some recommendations on that. That turned out to be pretty good. Same thing in the meat market. Nothing really surfacing in softs right now. Going back to energy, nat gas, we've also played that beautifully. We were buying bull put spreads down in this area down here in nat gas because the risk of a move was up. And then once it got up in this area here and started to roll over, buying bear call spreads, again, a credit spread made sense down to the trend line, the that has been going on really since the August, the summer timeframe. Once we broke that trend line, now it's going to serve as resistance. We may come up and test it and roll back over again. So we've had some really good trades here for folks that are following, especially some of the commodity trades and futures trades. We've done some really cool things in options that we're trading, trades that we call the baby fly and the gator. And we've got one on that I haven't taught our members yet, but it's called Rambo, which is going to work. It's working fairly well, and just some of these other trades, the super flies. So we're running a number of different adjuncts to a traditional balanced butterfly, and as few as some others as well. So these, I think you guys will really enjoy, members. Again, non-members, I highly encourage you to come in and check us out. We're having a fun time and we're making money, which I guess at the end of the day makes it a fun time. Everybody have a great weekend, members. I will see you this Sunday evening for our weekly market watch. Take care, folks. Ciao.